Welcome, everyone. I'm Pam Shellhorn with the University of Illinois Extension. I am a regional specialist in community and economic development, and I'm here today to talk to you about how to finance a business. I'm going to talk about both traditional and non-traditional sources of funding, and I hope you really enjoy this program. If you'd like to, please go ahead and leave your name and where you're from in the chat box. I'd love to see where everybody's coming from once the program is over with. And we are recording today. So, and I believe, did it start recording? Yes. Okay. We have a special guest today named Allison Grady. She's with the Illinois Department of Commerce and Economic Opportunity. She's going to be popping in while we go back and forth through these slides. And I also have a colleague, Mike Delaney, who's on board, who's going to be watching the chat for your questions. If I don't get to them throughout the program, I will definitely get to them at the end in the Q&A. I'm also going to be turning off the recording during the Q&A so that if you'd like, you can open your mics, and also if you want to, come on with a video so that we can have an interactive chat. But again, thanks for coming. Okay, how to finance a business. Now, I have been in commercial lending, or was in commercial lending, for over 2 decades. I actually made my first SBA loan in 1987. And most recently, I helped a couple of colleagues and friends buy a resort in Wisconsin with a $1.25 million SBA loan. So I still keep my fingers in this pie. I have a bachelor's in finance, and I have a master's in political studies. But I love finance. I love loans and grants and unique ways to finance businesses. It's all fun to me. So that's just where I'm coming from. I hope you enjoy it today. Okay, the first thing we have to do if we're going to borrow money is we have to be ready to borrow. We have to know exactly how much money we're going to need. My recommendation is that if you're an existing business, you need to have at least 3 years of financial information and a projected cash flow for those 3 years at a very minimum. If you're a startup, you're going to need a projected cash flow for the next 3 years, a projected cash flow showing how that loan's going to be repaid, because that's the important part to the lender, is will they be repaid? Or the important part to anyone that's lending you money is when will you be repaid and how will you repay it? What I'm recommending, and you'll notice on every slide that there will be a next steps at the bottom. And I want to let you know that you will receive a link to the recording, and you will also receive through email, you'll also receive a copy of the slide deck. So you could just wait if you want to till I send that out tomorrow. And that way you can click on these links at the bottom called Next Steps. I don't want people to feel like they have to photo shoot every single one of or screen print every single one of these slides. If you're planning on going in for a loan, you want to make sure you're prepared. So I recommend you find a small business development center near you. And that's what's at the bottom, are some links where you can find your local SBDC. I know a lot of you already know where that is. I was an SBDC director for several years. It's a super important thing. I was really sad when they closed some of the centers, but now I know some are opening back up, and they sure have been helpful through this pandemic. But again, make sure you know exactly how much money you need, and make sure you have those financial statements. If you can't put them together yourself, then make sure that you find someone who can, an accountant, a bookkeeper, maybe your uncle or your aunt that's got an accounting background. Especially if maybe you're a smaller business. Obviously, it depends upon how much you're borrowing, but if you're borrowing anything over $50,000, you're going to need this, and maybe even $25,000, you're going to need these financial statements at a very minimum. Okay, commercial loans. First thing I want to talk about here is the value of a good commercial bank relationship. I can't put enough emphasis on how important it is to have a good bank relationship. In fact, I can give you a great example. For those of you, most of you are probably You're familiar with the PPP loans or forgivable loans the federal government put into their CARE programs. What I do know is when those PPPs came out, it was a rush to the trough. And for those banks that had the power to do the PPP loans, I know a lot of people were finding out that they were handling their own customers first before they were reaching out to other people in the community. So building a commercial bank relationship can be critical. But I do know some people are not going to be eligible for traditional commercial bank financing. So we're going to talk about a few other things as well. Your commercial bank terms are probably going to require larger cash injections, generally about 25% of the purchase price of whatever you're purchasing or the total loan amount. 25% you're going to need to put in. Commercial loan rates can average between 2.2% and 13.2%, depending on the loan product and also depending on several underwriting factors, which includes your credit bureau. Lenders will ask for, and I want to put this in here because this is really important and a lot of people are not aware of this. A lender will ask for and take a second mortgage on your home if they feel they need additional collateral, and they generally feel they need additional collateral. So it's important to know that you're not alone. Now, some people would say, well, if I've got enough equity in my home, why don't I just go get an equity line of credit and use that for your business? You could, but you're not building a commercial bank relationship. And when times get tough, that relationship can mean the difference between you getting, say, a $50,000 line of credit that you need in order to continue your business or not. So I really would recommend that even if you have equity in a home, if you're doing a business and you want a business loan, that you try to make a loan with a commercial lender. And also another warning, I'm going to give you lots of warnings throughout this program. Be careful of prepayment penalties. Most commercial lenders don't use prepayment penalties, but some of them can, and you want to make sure that when you do the loan that you ask. That means that if you pay the loan off before its maturity, that you have to pay a premium or a penalty or a fee in order to pay it off early. There shouldn't be prepayment penalties. Sometimes there are. Just make sure you're aware of that. Now, Allie, I'm going to ask you to jump in here. Allie's telling me that she has a program called Advantage Illinois. And when I talked to her about learning some of this stuff yesterday or the day before, she offered to come on and actually give us a couple minutes on this. So Allie, are you ready?
Yes, I am. Thanks, Pam. And again, thank you for having me on with you today. One of the programs that DCEO has is called Advantage Illinois, and it is part of a program that we have that you would call a participation loan program. And so what we do with this program is we work with approved lenders. Now, for this program, you would have to work with one of our lenders, or if you have a bank that would be interested in enrolling in this program, we're happy to bring more banks or more lending institutions in to this program. But what this will do is the state will basically step in to help provide financing to small businesses, where we will subordinate a lower interest rate to your commercial loan. So you would get approved for a loan through the lending institution, and then the state would step in through an application that then we would have between the lending institution and the state, and we would bring down that interest rate on that loan. So when you look about this, there's two different programs that we have under this. Our main Advantage Illinois, we can put up to 25% of a project funding to a cap of 50% of the loan or $1.5 million under this to get you 2% below the lender interest rate. Now, with that, we are also looking at, we want to see some job creation with this. So for every amount of about $50,000 or so that you're borrowing, we want to make sure that we're seeing job creation or job retention with it. I mean, that's part of what DCEO does. We want to make sure we're getting those jobs in there. Now, go ahead, Pam.
No, we understand that, Ally.
Okay.
Thanks.
If you happen to be a minority-owned business or woman-owned business, we have a subset of this called FAME, which is the Fund for the Advancement of Minority Enterprises. It just builds on that regular Advantage Illinois program and brings that interest rate down to a flat 2%. Again, we could take up to 50% of the project costs instead of 25%. It could go all the way up to 50% of this. Now, this, of course, won't fund everything because we're not going to go to the full extent of the loan or the full extent of the project costs, but this can help provide you some gap funding to help bridge that gap and provide some funding for your businesses in there.
That's great, Ally. Could you do me a favor, if you've got a minute, could you put a web link and also a contact number for you if people have additional questions on that Advantage Illinois in the chat box for me?
Absolutely, I'll be happy to do so.
Thank you. I also saw a question in the chat box that asked about how can you make a better commercial bank relationship. I'll tell you the number one way is that, well, other than paying all your bills on time, there's any commercial lenders on here, I'm sure they're chuckling. But what you can do is make sure all the bank products you have are with that commercial bank. When you're a personal or borrowing on a personal basis, having a checking account at one bank and a savings account at another bank and a CD at another bank and a car loan at another institution or maybe through Toyota Financial, that's fine. If you want to build a commercial bank relationship, bring that relation. That's what it is. It's a bank relationship. You want to bring all those relationships with you. Besides, if you are going from being a personal borrower and becoming a commercial or business borrower, that way they can see your checking account, they can see the way you make your loan payments. It's all internal. They have access to that. That's what it means to build a great bank relationship. Okay. Next one are SBA loans. I'm going over this quickly. What I'm going to recommend is if you're interested in an SBA loan, 7A or 504, still not going to describe it. Again, I'm at a mile high here. I'm going to go over at least 13 or 14 different ways to finance the business in the next 45 minutes. So I'm not going to take a lot of time. If you want to know more about it, you want to set up an appointment with the Small Business Development Center, or you may want to contact an SBA lender in your community. Again, make sure when you walk into their offices, you are as prepared as possible. There is a possibility sometimes for restructuring bank debt with an SBA 7A or 504. That's something you're going to have to talk to that lender about. But for businesses that may have had some financial difficulties over the the period of the pandemic, this may be an opportunity for you. First of all, if you want to go to the SBA, your loan application must be reduced or declined by a traditional commercial lender first. So you're going to have to go to a commercial lender first. This is not your first stop. You typically can do a lower down payment. I was talking about around 25% injection of your own money into a typical commercial loan, whereas with an SBA loan, it's generally about 10%. And according to a resource I checked yesterday, interest rates are currently between 2.25% and 5.75%. I'm going to warn you that if you get to the SBA portion of this, it's lots of paperwork, and you're generally going to have you will have a guarantee fee. There's also still, I want to let people know this, if you have a small business or you know of someone that was impacted by the COVID-19 and their businesses suffered, the Emergency Injury Disaster Loan Program is still available. I don't have the information, I thought I did, right in front of me. Let's see if I can find this one. Oh, yes, I do. The EIDL is currently 3.75% fixed, and you can have up to a 30-year amortization with no prepayment penalties or fees. It is not forgivable, though. This is not like the PPP program. Again, I would say your first step is to contact someone at the Small Business Development Center. but you should be a little bit farther along. You should have already talked with them, got a business plan, and been into a commercial lender. So this is like the next step when you can't get that traditional commercial loan. Oops. Okay. Now, next on grants and forgivable loans, Amy, you want to quickly take us through this?
Sure.
You were going to pop in here for me, correct?
Yes, absolutely.
Welcome back. And I'll say it for you, Amy, so you don't have to. There are no seed grants for small business startups. This is something some of you may be on this program for, is because you think I'm going to talk about grants for startups. There are none that Allie and I know about. And but she is going to talk about some grants and forgivable loans for businesses that were impacted by COVID-19. Okay, go ahead, Allie.
Sure. The one that a lot of people know about, or at least I hope so, is the Federal Paycheck Protection Loan, or PPP. This is, as Pam mentioned, a forgivable loan. We had the first round that the federal government did back in 2020, but they have opened up a second round that is opened right now through March 31st, or until they run out of funding. That is again a forgivable loan. If you have not applied previously and your business was you were in business as of February of 2020, you can go ahead and continue to apply for what they call a first draw loan. This will be your first time applying for PPP. If you did already apply for PPP and received those funds last year, you can, if you qualify, apply for a second round PPP loan and work through that. Both first round and second round are forgivable. The one thing about this program is you would work with your local lending institution if they have been qualified by SBA to do the PPP. So this is not one where you would apply to SBA directly. You're going to work through a local lending institution. We do have links to this on our website that'll get you to all the information on that program, and that link is down in the next steps. So go ahead and click through that, or myself or any of our SBDCs are standing in and able to help to a point with the PPPs and help get you going that way. We also have numerous webinars coming up from DCEO on those PPPs, so take a look at that. Other areas that you can look at is the Local Initiative Support Corporation has had multiple rounds of funding for grants since this pandemic began, targeting different areas, different industry groups. Right now, they don't have any that are open, but I encourage you to go on to their website that's listed below, and you can register for notifications for their upcoming rounds of grant funding. So this is going to continue to move forward. They're fairly easy grants to apply for once you look at them. So feel free to get on that notification list in case something comes up. One of the other things that I would have you take a look at or communicate with is watching things in your local community as well. There have been, over the last few months, various sources of local communities being able to provide support for businesses during COVID-19. So make sure you're taking advantage of those. Funding for those could be coming out of a fund that a local government has. It could be coming from the state to the local government to run those programs at a local level. So make sure you're staying on top of what your community is doing. For instance, the city of Springfield, I know Abby's on right now, they ran a program to assist small businesses with grants. I believe it was a $5,000 grant, and there have been numerous other communities across the state. I'm just talking with a couple that I know in my region. The village of Mount Pulaski, here just to the north of Springfield, did one way back in April, stood it up using a funding source that they had to help. So make sure you're watching what your local communities can do. But I also want to let you know, we're not completely out of this pandemic. There may be more things coming down the road. We know SBA is going to be rolling out a shuttered venue grant program as well. Our website, illinois.gov/DCEO, is a great place to watch and monitor for programs that will be opening and closing, whether the state has additional ones as more funding resources become available, or working on the federal side. So take a look at that. The other thing is there's a way on our website that you can, again, sign up for notifications, and we'll be able to share that information with you.
Thanks, Allie. That was great. Thank you so much. Get to the next screen. Okay, now we're going to turn away. This is where, and it's not necessarily that you were turned down for a commercial loan. This is some other ways to finance a business, but I am also going to talk about the pros and the cons of doing this. Now, using credit cards, would I ever recommend this? No, absolutely not. But according to a study that happened or occurred before the pandemic, it's the third most popular source of cash for small businesses. The big thing here with using credit cards to finance your business is you need to know the interest rate, number one. You have to check that rate. It can be way higher than even getting like a commercial loan, an SBA loan. There may be some other way to do this, but you need to check it because I have seen interest rates as high as 26% interest. And that you saw some of those interest rates I was showing you, 2 to 13%, 2 to 5%, 19 to 26% on a credit card. That could be a tough nut to crack when you're trying to get that paid out. If you have built up credit card debt, and I know lots of people have done this when they're in business, make sure you term it out by making regular monthly payments. I recommend a 1 to 5 year amortization, but it's really important that you look at that debt like you do all your other business debt. The other thing you want to remember is banks will generally not refinance credit cards. Neither will the SBA. I mean, I'm not saying it has never been done, especially if someone had adequate collateral to back up a loan to refinance credit card debt. But I'm going to say 99.9% of the time, banks are not going to want to refinance. Neither is the SBA. I also understand someone that got the big grant from the state of Illinois indicated they also were not able to pay off their credit card debt. They could only pay new expenses that were coming in. And you want to look for those lower interest rate cards, but remember, a 0% bank card or credit card is not necessarily 0%. You got to look at the fees. Generally, they're going to charge you at least 3 to 4% of the first year or right off the bat, which means you've got at least around a 4% interest rate. But definitely look for those lower rate cards if you have to use this mode of financing your business. Lesser financing. Lesser financing can be really important. A lot of times banks don't like to do or finance leasehold improvements, meaning that let's say you decide you're going to start a business, it's in a downtown, the building you walk in and it's nothing but studs, okay? And the landlord is saying, well, the build out is going to be yours. That means you're going to have to put the walls up, the fixtures, the furniture that is bolted to the ground. And that's one of the reasons why banks don't like it is it's hard to get out. It's sometimes impossible to remove. If you do get it out, the value has just plummeted. You might get 5 or 10 cents on the dollar. What happens in lesser financing is that the landlord or the lessor will roll that cost of the build out into your lease payments. So maybe your lease payments were going to be $1,200 a month, but once you build in this or build in the cost of the build out, it may take it up to say $1,600 a month. That extra $400 is to pay him off maybe or her off, the landlord off within say 5 years or whatever the course of the lease is. Be careful you don't include things you feel a landlord should provide, and you always want to get an attorney involved. You're going to hear me talking a lot about getting an attorney Anytime you're dealing with debt that's going to leave you, say more than $25,000 in the hole, I would really, any kind of a purchase, commercial loan, SBA loan, get an attorney involved from the get-go, and especially at your closing. I would never close a real estate deal without an attorney. And I recommend that any kind of a deal, business deal, what little money you may save, maybe $1,000, $2,000 for getting the attorney involved, you could lose tenfold over. So I really recommend that. But this is one idea or one way of incorporating your build out into your lease payments and have your lessor finance it for you. Borrowing from family and friends. This is the way a lot of businesses start out. In fact, I was looking at a project today because I'm going to talk for a couple of minutes on equity crowdfunding. And I found out that the initial investments in one of the campaigns was actually from family and friends. This is what I recommend. Document it just like it's any other loan. You can just create a simple promissory note is sufficient. Make sure you set up your terms up front. Maybe they'll let you pay interest only for the first year and a 5-year amortization, or maybe they'll even waive the interest. If it's going to be for something more than $5,000 or more, I would also include an attorney or get an attorney involved to draw up this contract. You want to make sure from the get-go that that family or friend knows when you're going to be paying them back. This is where I've seen a lot of issues with businesses. They get after like the first year, and of course, people are thinking, I thought you were going to pay me back. And well, you want to make sure they know this might take a while. A lot of times, if they're the ones investing and say maybe they're the ones that are loaning you a down payment or your initial injection, or they helped you get back on your feet. The thing is that it could take a while before they're in line to get their money out of this business. So I like to do it right up front. Obviously, family and friends, it can make for some pretty nasty Thanksgivings. Always a little bit of preparation helps. Use your 401k. Yeah, you can use your 401k. Lots of businesses do. Understand there's steep tax consequences and penalties. I was saying get an attorney involved in a commercial loan, an SBA loan, and a lesser financing. I recommend you get an accountant, a tax accountant involved in this. You will pay a 10% penalty unless you're at least 59 and a half. Now, there are some exceptions due to the COVID-19. There were, excuse me, the federal government made some exceptions to this, but ordinarily you will pay a 10% penalty until you're 59 and a half. And you will also have federal and state tax liabilities on this because, as you know, your 401k goes in pre-tax. There's also sometimes an employer can have a funded pension plan that you can borrow from. You might want to check with your employer on that. They don't do that as often as they may have done that 10 or 20 years ago, but it's something you can check on. Excuse me, I had to take a break. I've got a little dry throat here. Okay, next. Sorry, this dry throat really got me there. So sorry. Here we go. Buying on contract. I've seen a lot of businesses sold on contract. It's something you need to be very careful for. But what happens is it's just like buying a house on contract. You can't get typical financing. You can't get the commercial loan. You can't get the SBA loan. You don't have family to loan you the money. And so the seller decides that they'll offer financing for you. Number one, consider having an independent appraisal. You want to make sure what you're buying is worth what they're selling it for. If you're not going through a bank or the SBA, who will make sure they get an appraisal, an independent appraisal, that they have the collateral that they think they have, you need to make sure you have one. Second, and notice I have this in all capital letters. That's because I'm screaming it at you. Hire an attorney to draw up and review all contracts. And just to note, a realtor is not an attorney. They want to sell this business. You don't use the realtor as an attorney. You also don't use the seller's attorney for your attorney. They might say, okay, that's all right. I have an attorney. They're going to draw up the contracts. You just sign them. No, you bring your own attorney to review those contracts. She's going to make sure that she's working for you and that things are in your best interest while their attorney is working for them. Now, the other thing you have to remember with buying on contract is usually it has a balloon payment in the contract. That means in 5 years, you are going to have to refinance this when it balloons. And generally it's about how long it is. It's about 5 years for a balloon on a seller financing. It could be 2, it could be 1, it could be 10, it could be 20. Generally it's about 5. But if you can't borrow the money to pay it off now, you need to know that you have a way to pay that off when it balloons in 5 years. Okay, now, unfortunately, I know Abby Powell's on the line, on the call. So we get to the end. You have any questions or questions about this page? I know she is much more of an expert. But look, there's local development funding. Almost every community or larger community, I should say, not all rural communities, but some of them do, have organizations that have been like certified development corporations, a CDC, or maybe the city has a tax increment financing program. You'll find revolving loan funds, and then there's others that make micro loans. All you have to do is Google one of these and you'll find out, or contact your city, your local economic development organization, or your local SBDC to see if there's programs available like this in your community. They're normally lower interest rates, and generally they're going to take on a little more risk. In fact, sometimes they can get involved with that commercial lender even before you go to the SBDC, or excuse me, the Small Business Administration, the SBA. They may be able to get involved and actually put in what Allie was talking about, that gap financing. So maybe you can't come up with the whole 25,000, but maybe one of these, microloan, revolving loan fund, tax increment financing, they might be able to get involved and make up that difference, or make up a small difference. So maybe you're putting in 10 or 15% and this loan is coming out. Now it'll be in a second position behind the bank, so that the bank still feels secure that they're only financing 75% of the project. But it is going to increase the amount of debt you have. I really recommend that you look for these types of financing, because for some of you, if you're not borrowing $1 million or $500,000, you might be able to get something from a revolving loan fund or a micro loan for $10,000 or $20,000 to get yourself set up and started in business, and then head for a commercial lender when your funding status or your credit bureau or your business has been in business long enough to make it worthwhile for them to take over the loan. Angel investors. If you're looking for more money, if you're looking for 50,000, 100,000, $1 million, sometimes it's even more than that, an angel investor, there's a lot of them out there. But generally, this is what you have to understand about this. First of all, you have to find them, and they're easy to find. You'll notice under the next steps, there's 1, 2, 3 links that I have where you can go look at what these angel investors want, how much they're willing to put into a project. But an angel investor meaning they're going to have an equity position. That means they're going to own part of your company. In fact, they're going to want 25% to 40% of that company. Now, generally, an angel investor is someone that's not only saved a lot of money and has a lot of money to invest, but they also generally are entrepreneurs themselves, or serial entrepreneurs, and they should be able to provide some excellent business guidance as well. So you're not just taking in a partner and getting some money and selling 25 to 40% of your company, you're also going to get some expertise with it. Now, anyone can be a financial or can be an angel investor if they have the financial capabilities. Generally, it requires about $10,000, but oftentimes that investment can be hundreds of thousands of dollars, and it could take more funding over time. So generally, you're going to find, in fact, I went out on a couple of these pages just to look where they're talking about where they have 100,000 to invest or they have $1 million to invest. So these are typically larger amounts of investment capital. Now, attracting an angel investor is not easy because they're looking for returns on their investment of 25 to 60% to offset their risk. So they're looking for a high growth company that's going to turn it around. Now, that doesn't mean it's not going to take a, say, artisan bakery and look at that as a potential. But that's where those financial statements and having some great financial statements that show how much money you can make on this business are going to be really critical if you're going after an angel investor. Community ownership. Now, I know a couple of you are on this call because you're talking about what can our community do. And I've seen both of these work really well when a community, especially maybe a rural community that has, or even an urban community, but it's a business that is really important. It's a coffee shop, or it's a restaurant, or it's another business that's really critical for the community. So the community gets involved. The first one is called Community Supported Enterprises, CSEs. Norm Waltzer, many of you may have heard of him. He's been around for a while, but he's at Northern Illinois University, but he has done this. He's even taught it in Scotland. In fact, they're using it in the UK to publicly finance many of their pubs because the pub was the central sort of nucleus of these communities. And so they want to make sure that they're community supported enterprises. Now, the thing is these are still businesses. These are not profits. They have a profit motive. It just means that they're strictly social enterprises. They're not financed with donations. They're financed with they actually are going to be financed by the money that the owners put into it, but now the owners are going to be community members. The second type is cooperatives. And cooperatives, I'm sure many of you heard of the cooperative. It's used a lot for things like whole food stores or organic food stores, things that are very difficult to finance traditionally. So people come together. The only thing is everyone is on the same level. It brings people together, it says, in a democratic and equal way. An example of this is you might have 20 owners. Every single one of them has one vote, the same vote, but one owner may have put in $20,000 and another owner may have put in $200. It isn't like a typical corporation where the more you own, or a typical company, the more you own, the more control you have. We talk about 51% control. No, in this case, it's where all the owners are on the same level. And for cooperatives, they have a wonderful cooperative development center at Western Illinois University. The link is going to be at the bottom here. If you're interested in either one of these types, this can be really powerful if you're looking for a way to save a business. It doesn't necessarily mean that the original owner is going to keep it. In fact, he probably or she probably won't. It's going to be more of a community group that comes in. And one great example of this is in Belvidere, Illinois. I'm not sure if it's around anymore. I meant to check on this, but it was around for a long time. I know, if it still isn't. They wanted a coffee shop. So an investor, now he didn't do, well, it was a CSE, but it was only one investor. He came in, bought the building, let the first people that came in build it out. And then he just leased it. So he was, sort of the lesser financing with a twist. But it was like the first owners, the second owners, the third owners. But what he made sure that even though the owners were sort of a revolving door for a while, there was always this coffee shop in Belvidere. And again, I will double check that. If anyone knows, please put it in the chat box if you're familiar with Belvedere and know if it's, I think it was called the Witch's Brew. He did keep the name the same, they just changed owners. Crowdfunding. I love crowdfunding. Crowdfunding is cool. I can't believe more companies and more small businesses don't do it. It might be that they're a little worried they don't understand it, but crowdfunding is incredible. It's capital you don't have to pay back. There's no credit checks, but you have to have a checking account. It tests your market. It creates transparency and accountability. Everybody in the community knows what's going on. It's a way to promote your business or organization. It tests community support in projects that are, say, not for profit. And it's sophisticated online presence. I mean, it creates most of them. If you look at Kickstarter, GoFundMe, or some of these others, you create this wonderful site. The problem is people think that just because you have a Kickstarter, a crowdfunding campaign, that people are going to find you online, okay? And you're going to be able to just put the crowdfunding campaign out there, sit back and let people donate. Well, no, that's not the way it is. You're going to need a lot of people to help you in running a successful crowdfunding campaign. It's just like running any kind of a fundraising campaign, but you're probably going to be doing it in a for-profit situation. Generally, the campaign will last no longer than 30, 60 days. I actually I helped manage, I should say, a crowdfunding campaign for a community garden in Mount Vernon, Illinois. We raised over $4,500. Our goal was $3,500 in less 30 days. Now, the thing is had I not been working with an entire team, I mean, there were dozens of people involved in this, including the city, some of the aldermen, the city clerk, all the people working on the gardens. Had it not been for them going out and finding these people to make these investments or, make these, we call them backers. They're not really donations because the money you do get is taxable. So that's something to keep in mind. But it really takes a village in order to do a crowdfunding campaign. Okay, the common platforms for crowdfunding, Kickstarter is my favorite. GoFundMe, but a Kickstarter you can't use for a not-for-profit. GoFundMe, Indiegogo, the list goes on. There's actually over 500 of them worldwide. The one thing to keep in mind with crowdfunding is you need to find that platform you want to use, but make sure you know if it's an all or nothing or a keep it all. For instance, a lot of people use GoFundMe, like the city market up in Rockford, Illinois, just did a GoFundMe crowdfunding campaign, and they raised around $30,000 to manage to keep the city market open because of all the hits they took from the pandemic. GoFundMe is all or nothing. Is keep it all. I apologize. That's keep it all, meaning you do a GoFundMe campaign. You may say your goal is 500, but if you only raise 200, say your goal is 5,000, but if you only raise 2,500, you still keep the whole 2,500. Kickstarter is not, and a lot of them are not. They're all or nothing, meaning that when we did a Kickstarter campaign for the gardens, we set a goal of 3,500. Had we not reached that 3,500, we would have had to send all that money back to all of the backers. Instead, we, of course, got to almost 4,500. So we kept it all. Now, the one nice thing about an all or nothing is, as this quote comes, is a credible signal to the crowd that the entrepreneur commits not to undertake the project if not enough is raised. This reduces the risk to the crowd, meaning that if they're investing in your business and you're trying to raise $5,000, but you only raise 2,500, well, then all you've got is 2,500. You get the money if it was GoFundMe, but that doesn't necessarily mean you're going to be able to create that business or start that business or to even become profitable if you really needed the $5,000. So anyway, it does make it more credible with the all or nothing, but you know, if it's your first time out, you might want to try something with the keep it all. You're going to need a lead fundraiser. You're going to need a strategic plan for managing the campaign. You're going to need a great marketing plan and an even better campaign team. Now, the reason I'm saying this is I actually created a program called Managing a Successful Crowdfunding Campaign. And I gave it at a conference in February 2017 for a national conference in Orlando, Florida. If I do work with communities, so if that is something that your community is interested in me giving so that your small businesses, or maybe you're even thinking about doing it in order to start one of those community supported enterprises, please send me an email. Any questions, you can send me an email, but I would be happy to give that program again. You're going to have to update this on a daily basis. You're going to have to be able to answer your, I said investors, but I meant your backers questions. You need videos, you need social media presence. You need an in-person networking to find your backers. Remember, these are very short. They only last 30 to 60 days. So if you decide to do a crowdfunding campaign, you have to be ready and have those supporters to be able to work on this day in and day out until you've reached your goal. So it's fun though. It was exhilarating. I was so afraid we were going to fail, but we didn't. And we not only raised the $4,500, but in the process, we found a plumbing company in the area that donated over $8,000 worth of plumbing in order to get water to the gardens at the park that we put it in Mount Vernon. It was a very exciting time, but it's a lot more work than I think people think it is. Maeve's Coffee in Alton, Illinois is actually a great example. Now, what they did is rather than just asking for the money to start a business, they asked for specific things that enhanced their business. Like they had an original goal of $15,000 for an espresso machine. The second time they went out for a Kickstarter campaign, they built an outdoor patio and their goal was $10,000. And as you can see, it took 228 backers to pledge $15,782. And in 2015, they had 208 backers pledged $12,146. As I mentioned, Maeve's Coffee Shop is in Alton, Illinois, and they did a great job on crowdfunding and were able to do a lot of great things in the community. Equity crowdfunding, this is something I'm just getting into. I mean, it's really interesting. I'm enjoying it a lot. But it was something started with the 2012 Jobs Act. Excuse me again, I'm going to have to mute. I'm going to have to cough. It's so dry with this horrible weather. I hope everyone out there is staying warm. Equity crowdfunding was allowed through the 2012 Jobs Act. I'm not going to say a lot about this. The thing is with equity crowdfunding, this is an investment arrangement. There is an entity issues equity or shares of company stock to participating investors on a proportional basis. It takes a lot of partners. If you think traditional crowdfunding, as I mentioned, takes tons of partners to reach your goals, equity crowdfunding can be just as much, but I have seen successful campaigns that have gotten everywhere from $10,000 to millions of dollars for projects through equity crowdfunding. And there's tons of sites. And from what I understand, most of these sites are going to lead you through this process. There's a lot of paperwork. You're going to need things like an accountant because you're going to have financial statements. You're going to have SEC filings. But I don't want all of that to scare you away, especially if you're looking for something. You know, we were talking about community supported enterprises. Sometimes equity crowdfunding would be the way to go. It's just you're going to have to be able to educate your investors so that they understand what they're getting and how that's going to impact them in the future, what the risks are. Generally, from what I'm seeing, because like I said, I'm just in the process of really understanding equity crowdfunding right now. So hopefully I can help communities with this in the future. But what I'm seeing right now is generally you're only, what you can lose is what you invest. So if you decide to buy $1,000 of stock in an equity crowdfunding project, you could lose $1,000, but yeah, and of course you want an attorney to review some of your documents or make sure you understand that that's all you're going to lose is that investment. Okay. Now, this is the last thing I'm going to talk about. I don't want to depress anyone, okay? But when you see a bankruptcy attorney is critical. Timing is critical, okay? If you're even thinking that, oh my gosh, we've been out of business for so long, or we've been shut down for so long, or we've got so much debt, I'm wondering if we're going to have to go bankrupt. I know people are in denial first. Oh, this isn't going to happen to me. I don't need an exit strategy. But personally, I think you should develop an exit strategy about the same time you start your business to know how you're going to go out of business. But the critical statement here is you want to meet with a bankruptcy attorney several months before you think it's going to be a possibility. The reason for this is and I'm not an attorney, I'm not a bankruptcy attorney, and I'm not going to go into this in detail. The laws have changed since I was in banking, and I was involved in a lot of bankruptcies, I did million-dollar workout loans, and I sat in a courtroom over and over through bankruptcy. And the one thing I saw is some things you can go bankrupt on, some things you cannot. And what happens is you're in trouble and you're, sort of paying the squeaky wheel. Whoever, the squeaky wheel gets the grease is what we always used to say, but you're paying the squeaky wheel. You want to find out what you can go bankrupt on and what you can't. And if it's something you can't go bankrupt on, then you want to make sure you keep those payments up to date. If it's something you can go bankrupt on, then you're going to try to postpone paying that. Now, I know whoever's out there that's a vendor going, oh, well, thanks, Pam. But truthfully, bankruptcy is tough enough than to get in and find out that $20,000 you had 2 months ago that you spent on this, well, that you could have gone bankrupt on. But the 20,000 you could have spent on something else that you can't. So you want to get in there as soon as you know. Okay. I'm going to say this quote, then we're going to finish up and turn it over for questions. I love this. I told you I was reading about successful equity crowdfunding campaigns. And there's this guy named Patrick Henry, should look it up, the 7 secret ingredients to a successful equity crowdfunding campaign. But he said this, and this is what I say to all these businesses, whether they're going into business, they're in business, whether they're struggling, through the pandemic. One thing I've learned about business and fundraising over the years, as long as you believe in what you're doing, never give up. You will find a path where there apparently is none. Eventually, others will start to understand your vision and the potential of your idea. Your persistence will break down the resistance. Enjoy the entrepreneurial journey. I love that quote. I just wanted to say that. Now, I am going to stop this recording so that we can look at these questions. And for anyone that's watching the recording, I want to let them know this was done on February 7th, 2021, or February 17th, 2021. And all of this information is updated as of this date. Thank you, and thank you for joining us.